Hello and welcome to the Charter Hall Direct Insight series. I'm Steve Bennett and I'm the CEO of the Direct business here at Charter Hall. I'd like to begin today by firstly acknowledging the traditional custodians of the land on which we each gather today and pay my respects to the elders past and present. And thank you all for joining me for this update on Charter Hall and our direct suite of funds for the December 2023 quarter. It's no secret that the past year has presented us with a range of challenges to economies both domestically and throughout the world. A combination of capacity constraints drove inflation, which resulted in significant and rapid interest rate rises throughout Australia and globally. This led to an increased cost of debt, which has flowed through and impacted many asset classes, including Australian property. Over the last 12 months to December 23, we've been focused on actively managing risks where possible by being proactive with extending our lease terms, and we've lengthened debt facility maturities and maintained an overall portfolio occupancy across the funds of 99.5%. I'll provide more detail around these areas of focus later on in today's presentation. I'd also like to remind you that we're not able to provide financial advice. Today's information is an update on our funds and the external market, but if you do have queries that relate to your own personal investment, we always encourage you to consult a financial advisor, to read the product disclosure statement or information memorandum in full, and pay particular attention to the risks section. And today we have a special guest speaker, David Harrison, Managing Director and Group CEO at Charter Hall. Today, David will be providing his insights and views on the current economic conditions and the Australian commercial property market. Then I'll be touching on some of the valuation insights following the December 2023 valuation period and talk through some of the key factors that have impacted these property valuations. I'll then pass through to Fund Manager Julian Menegazzo, who'll give you an update across our direct suite of funds in more detail. So the first thing I'll cover off today is the Charter Hall Group high-level overview. Charter Hall recently put out half-year accounts and detailed analyst presentations, which are available on our website, and I encourage you, if you want more information, to go to that source. I will just draw your attention to a couple of key things on this slide. You can see the scale of the platform, the number of properties, and the continued focus on long-term leases. The scale is important because it does make it easier to negotiate with tenants, build deeper and longer-lasting relationships with external agencies, banks, and ultimately, we should be able to use the scale of the platform to deliver better returns for our investors over a long period of time. Moving now through to the direct business, you can see it's a little under 10 billion of funds under management, over 100 assets, and over 400 tenants. The reason I highlight this is because diversification is key when you are looking at certain investment classes. And whilst you can invest in single asset syndicates, it is important to be aware that they are just concentrating risk and exposure into one particular market and often just to one tenant. So you can see there the 99.5% occupancy, which is the average across our open and closed funds in the direct business, is market leading. So it exceeds all Property Council of Australia benchmarks regardless of the asset class. And you will hear more from Julian later on in today's presentation on the specific fund metrics for the open and closed funds. So now I'd like to introduce David Harrison. David is Charter Hall's Managing Director and Group CEO with over 37 years of global property market experience. David has been instrumental in overseeing the significant growth of the Charter Hall Group since CHC first listed on the ASX in 2005. Thanks for joining us, David.
You're welcome.
Why don't we start bigger picture at the macro level? It's been a volatile 12 months. We've seen significant movements in inflation, interest rates, bond yields, a little bit of global economic uncertainty. What do you think it means for the Australian commercial property sector going forward?
Look, it's a complex environment we've been in, but what I would say is there's two elements to the dividends or distributions that you get out of property. One is your income line and one is your expense line, which is driven by debt costs. The reality is that commercial property in all sectors, even office, much maligned, has been continuing to produce solid income growth across all of our portfolios. Yes, interest expense has gone up, whether you have a residential mortgage or you've got debt on commercial property. The rapid rise in interest rates has meant the interest expense has grown, and that's eaten into the growth in the income line. We're seeing rates stabilise, we're seeing inflation stabilise. Ironically, despite all of the suggestions from economists that the US may well see inflation fall and interest rates fall before Australia, I'm probably in the camp that we may well see peak rates and then rates falling from central banks at about the same time in Australia as the US. But what I would say is that fundamentally the characteristics of all sectors in the commercial property area, particularly for high quality property, are still in good shape. We'll talk about office, but you know, what I'd say to people is remember 80% of all the vacancy factors that you see reported sit in 20% of the office stock, predominantly older stock in poor locations. In the prime markets, occupancy is holding up. Charter Hall still has the highest office occupancy of any major peer in Australia at about 97%. Some of our peers are as low as 87%, and obviously the average vacancy across all the major markets is around sort of 10 or 11%. It is like picking stocks in the stock market. There are winners and losers, and you really need to stay focused and patient on good quality real estate with a growing income stream.
So look, moving on to valuations, it's arguably one of the toughest years since the GFC over the last 12 months. The valuations have impacted the performance of the funds. You sit across over 1,600 assets, see everything across the group. What, for our audience, if you could explain the key drivers behind what's really been happening around these valuation movements?
Well, I think it's pretty simple, and I have the same discussion with our big super funds and global pension funds. When interest rates fall, as they did from about 2013, 2014, the cap rate or the capitalisation rate on all asset classes, but and including commercial property, the cap rates fall and they drive valuation growth above the embedded income growth. At times when you have a rapid rise in bond yields and interest rates, as we've seen in the last 18 months, cap rates rise faster than the income growth, and that means your valuations come down. What I would say to people is that these things fluctuate, but what's important with high quality property is keep it high occupancy, make sure you can get inbuilt rental reviews, whether they're fixed reviews or CPI linked, so that your income growth can outlast this volatile movement in interest expense. So valuations, yes, have come down. All the major property companies have reported valuation falls, but I'd also remind people that valuations also rose quite appreciably from 2017 to virtually peak June 22, and then as interest rates have risen, well, cap rates have risen. But equally, we're probably getting to the top of the cap rate cycle, which basically means, as interest rates and bond yields fall, there's a reasonable expectation based on 40 years of history that cap rates might fall as well. Now, when cap rates stabilise, you're going to get valuation growth in line with your rental growth. If you also have what we saw from 2015 through to 2022, cap rates falling and income growth going up, you're going to have outsized valuation growth. So I think people need to stay focused on the long term when you're investing in property, and particularly focus on high quality tenant covenants that don't go broke. Yep. We've got the largest office exposure from office tenant customers across our $30 billion office portfolio. About 36% of all of our office assets are leased to government. A very high proportion are leased to high quality blue chip corporate tenants, as well as that government exposure. So the risk of default is very low in all of our property portfolios, and therefore the sustainability of that income, occupancy and rental growth gives us some cause to be optimistic about the medium term.
And we just went through the COVID period, lockdowns, and as a group, there was little to no tenancy defaults in arguably the toughest economic conditions that we have had in 15 years. And the next question, David, maybe a little bit cheeky, and it is something that myself and the team do get asked, and hopefully you can answer it. But do you think we're at the bottom, or are we getting closer to the bottom of the valuation cycle?
Oh, there's no doubt. Just like the world thinks we're more or less at peak rates, and there's very few economists predicting a rise in official cash rates, and the whole speculation in the capital markets is when central banks will start reducing interest rates. My sense is broadly we're at the top of the cycle in terms of cap rates. I'd remind a lot of people that we've had a pretty significant increase in cap rates across most sectors. It'll be very property specific. So if you've got risk and you've got a lower occupancy rate and higher vacancy rate, there may be some differential impacts on those valuations. As a general comment, I would say we're certainly seeing evidence of a bottoming of valuations for CPI linked assets. Most of our portfolio, we're the largest owner of triple net assets in the country across all sectors. Most of our CPI linked assets have triple net leases, which means the tenant pays for all outgoings and all capital or capex. So my view is that depending on particular sectors, we're pretty close to sort of trough valuations. And as I said, if cap rates even stay flat where they are, you have this inbuilt income growth that will provide some rise in valuations over time.
Okay, that's good information and gives a bit of clarity. And look, obviously, as David mentioned, things can and do change, but we have seen some material movements in cap rates. And yeah, we're very transparent in the valuation process at Charter Hall, and I'll talk to that in more detail in today's
presentation. Can I just add, Steve, gearing's not always a dirty word. The reason why the net tangible assets or unit prices of funds rose steeply when interest rates fell and cap rates fell is that the asset value growth was amplified by 30% gearing or whatever the gearing is. Equally, when we get to a trough cycle, because that gearing has amplified net devaluations, as assets rise, it amplifies the growth in net tangible assets and your unit prices. One thing that is very important to us is maintaining strong rental cash flow at the underlying property level. And that will help us the most to drive valuation growth, even if cap rates stabilise and don't change.
Okay, excellent. And I guess moving back towards the long term, you present a lot of PCA, external events in the paper. You have been quoted on numerous times around the shifts to automation, the risks of older assets compared to more modern property stock, and where you think the best opportunities are. Is that something you still hold, and how are we leaning into that?
Well, it depends on the sectors. There's no doubt in my mind we are seeing a bifurcation of tenant demand in the office sector. Tenants, employers, gradually either mandating or encouraging their people to work in the office more, whereas during the pandemic there was a lot of work from home. Many of our major tenants, both government and corporate, are saying they want the very best modern properties because they're going to provide the best ESG credentials and accommodation, and the location is also going to provide retail and hospitality amenity for their staff when they come into the office. So I think the bifurcation of tenant demand for office is real, and I think we're going to see that continue. You only have to look at our major office developments. We're building another Chifley Tower, right in the core of Sydney CBD, it's almost 60% pre-leased, and we've only just started construction.
60 King William
3 years out, 60 King William Street. Another example, virtually pre-leased before completion. We're at about 70% on a project in Brisbane, which has still got another year under construction. Another project we just finished before Christmas, the new head office of Australia Post in Melbourne, was 95% pre-committed prior to completion. So there's evidence of this demand I'm talking about for modern assets. Charter Hall has got the youngest average age of office buildings across any of the major managers in the country. And part of our focus is whether we're buying stabilised assets or we're building new stock, we want to keep them modernised. So even if we have existing assets, we're constantly looking to ensure the lobbies and the amenity of those facilities are first rate so that we can maintain that sector leading occupancy that we talked about earlier. In industrial, there's no doubt we are seeing major corporates shift to purpose-built new facilities where they can invest large amounts of capital in automation. Very difficult to do that in a 30 or 40-year-old asset. Now, at the moment, there's virtually zero vacancy in industrial, so everyone's, riding the wave of rental growth. Our view is that unless there's a very high land value, you want to recycle into the more modern facilities, build your own, and also ensure that your stabilised assets are fit for purpose. I think it's different in shopping centres and other parts of the retail sector, which by their nature are constantly going through maintenance and capital upgrades. So the age of a shopping centre is less relevant than it is in office.
Location, catchment.
Location, major arterials, catchment, these are all important things. But even our Bunnings portfolios, are generally the latest Bunnings specification. They're not the old BBC hardware house conversions. So we own in our whole Bunnings portfolio the modern Bunnings model that Bunnings has built themselves, rather than we're inheriting a 30-year-old BBC hardware house.
And look, I'll just pick up something you mentioned around working from home. It wouldn't be an update, and it'd be remiss of me having you here if I don't ask a little bit more. Are you seeing our big tenants wanting to come back and get in their stuff back? Because the narrative around working from home and the presence in the office has definitely been changing over the last 12 months.
Oh, there's no doubt. You've had recent examples like major US companies even telling their staff, if you live too far away from work, you need to move and be closer to work because we expect you to be in the office. Ross McEwen, the CEO of National Australia Bank, was quoted in the newspaper this week that when they moved their people into our new 60 King William Street premium grade building in Adelaide, they doubled the staff attendance in the NAB offices. So I think there's plenty of evidence of that happening. The government sector's probably been a little slower. However, I think that's starting to change as well. And there's no doubt that, as unemployment starts creeping up, I think, generally people will be far more focused on aligning with what their employers want. And I think we'll see an escalation in working in the office. I think a lot of organisations like Charter Hall will maintain flex strategies, but at the end of the day, the evidence is stark that productivity is much better when your people are working in an office environment and collaborating and mentoring the young people that need to be mentored, rather than trying to do it on a Zoom call.
And periods of change, and you touched on at the start around the rapid increase in interest rates, volatility creates opportunities and risks. We've talked about some of the risks already around valuations. To balance out the discussion, where do you see the opportunities?
Well, I think if I go through the history of Charter Hall since we listed in 2005, our greatest period of growth has been after correction cycles, whether it's the sort of GFC or even the onset of COVID. And I see this as an opportunity where if we're out acquiring assets or even developing them, the yields and the total returns are better than they would have been a year and a half ago.
Yep.
We are seeing pockets of value add opportunities. Development is very difficult. Construction cost inflation is well documented. The required returns we and others want on development have risen in line with bond yields. So what we are seeing is tenants who want new office space, for example, are going to need to be paying pretty significant premiums to existing rents to get the very best in new accommodation. That's particularly the case in industrial. If you want a new industrial warehouse, distribution facility, or even manufacturing facility built for you, you're going to have to pay what we call an economic rent, which is the rent required to justify the cost of development. So I see lots of different opportunities. I also see, as bond yields peak and start to fall, the re-emergence of strong demand for long lease blue chip tenant covenants. It's become a little counterintuitive in the industrial market, but through normal cycles, people will pay more money for modern long lease blue chip tenant covenant assets than they will for short lease risky older assets. So that dynamic is about to change during the course of 24 and beyond. And I also think that we at Charter Hall have been pretty good on both picking sectors and macro themes that are going to drive outsized returns, but also avoiding the dogs or the pitfalls. And there's plenty of examples of sectors that we have stayed away from and avoided pretty serious sort of valuation decline over the last decade or two. So I think we'll continue to do that, and we'll continue to curate opportunities and present them to our investors.
Okay, fantastic. And I guess as head of our business, you have more exposure to some of the largest wholesale global investors, not just in Australia, but North America, Asia, Europe. What are you hearing from them in terms of how they see the Australian property market now, but probably more interestingly going forward and where they're looking to invest?
So I think you've got to start with, if you're a global investor, you're looking at Asia as a geography, just like you'd look at North America or Europe. Asia as a geography, the only two real core markets that are seen as core, transparent, relatively low risk are Australia and Japan. There's a lot of volatility in other parts of Asia, so a lot of core capital is wanting to allocate to Asia generally. The population growth in Asia is massively outpacing North America and particularly Europe over the next 50 years, and therefore people see Australia as being a great transparent proxy for investing in that population growth story in Asia. I think equally, because of the stability of our markets and we don't have a lot of speculative development that creates lots of oversupply that has occurred in other parts of the world, we're seen as a reasonably safe haven for global capital. But, the reality is Australia's out there competing for capital with every other major commercial market. So, because of, cap rates and discount rates rising, we are now screening as an attractive place. We will see a lot more global capital looking to invest in Australia. I think we'll continue to see a lot of Australian super fund money invest in the domestic market. A big chunk of the last 12 months of transactions in industrial have been funded by Aussie super funds, who are massively underweight industrial as an allocation compared to their global peers. So I see that continuing. So I think from both an Australian super fund perspective and a global pension fund or global sovereign perspective, Australia is going to continue to be an attractive destination, and in many ways will probably get an outsized allocation relative to Australia's population compared to the rest of Asia or the rest of the world.
And it makes sense. I always say at these things, demographics are your friend in real estate, and Australia's population growth is performing strongly. And there's many surveys, ANREV, survey global investors, and a lot of the Australian markets are consistently ranked 1, 2, 3, whether it's Aussie industrial, residential and so on. David, we've gone into a bit of detail. I appreciate your time, but it'd be good for our audience. We'll finish with a couple of quick questions.
Is this like 60 seconds with
60
Sterlo?
seconds with Sterlo, very quick,
Okay.
punchy. Best performing sector you think in the medium term?
I think logistics, industrial and logistics will continue to outperform in the medium term. It's got a virtual zero vacancy, strong underlying demand, not a lot of new supply, and the multiplier effect from population growth, which creates outsized demand for warehouse space, I think is a very good macro tailwind.
Okay, I'll conflict you here. We've got listed, we've got unlisted. What's your best way to get property exposure?
It's like my 4 children, I love them all. So look, you play the listed market in an opportunistic sense. At the moment, you can buy good quality REITs at steep discounts to underlying net tangible assets, but with that comes volatility, and you're looking at the price every day. So you've got to decide whether you've got an appetite for volatility when you invest in listed REITs, but there's no doubt, we've grown our business investing in REITs to nearly 500 million now. I'd say we're in the top 10 active investors in the Australian REIT sector, and we'll continue to make those opportunities available to all of our investors. Equally, on the unlisted side, you get less volatility, and provided you're investing in good quality assets and with the sort of characteristics I've talked about, I think there's a strong motivation, and let's face it, the pricing now is quite attractive when you sort of look at IRR, income yields plus capital growth prospectively over the next 5 to 10 years versus putting your cash in the bank. I think that's going to be attractive, and I think it will get more attractive as term deposits and cash rates start falling. But both in listed and unlisted, you need to be careful about who you're investing with, the management team of either a REIT or you, in the unlisted world, who your manager is, and also the quality of the assets that they're investing and the underlying tenant covenants. I keep stressing that. That is going to be something that is going to hold really high quality portfolios apart from some not so great portfolios.
Okay, one word, just one, how you would summarise your expectations for the year ahead.
Trough.
Okay, good, you heard it here first. And finally, last question for today, number one tip for property investors.
Be patient. Property is a long-term investment. If you want short-term investment, go and buy tech stocks or mining companies. Property is a long-term investment. The reason why the big super funds and the big pension funds invest in property is not just for the absolute returns, but also the lower volatility than the stock market. So I think you need to be patient, accept that you'll continue to get pretty good income returns and some capital growth. There'll be some volatility because assets go up and down, but over the long term, I think you've got to stay patient.
Okay, I think that last answer in particular is very relevant for our audience around the time frames you need to be looking at when you are considering unlisted property investments. So David, thank you very much. Great to have you here today. And I'll now get back into the rest of the quarterly update. Thank you, David. We just heard from David a number of factors that flow through into property valuations, and just to reiterate, higher inflation, higher interest rates and a lifting of return hurdles investors require are all short-term negatives for valuations of commercial property. We have seen across our portfolio market rental growth pretty much across all the asset classes and the sectors. And we do expect 2023 to be a trough year for the transaction volume, and calendar year 2024 us to see more transaction volume across all the core real estate sectors of office, industrial and logistics, as well as retail. One of the questions we also get asked a lot by our investors is, well, why have residential property valuations increased and that not being matched by commercial property? Well, whilst a number of drivers are similar, so population growth, demographics, the time frames that they play out are often different. When you have people moving to the country, the demand and requirement for housing is immediate. The other thing I would say is that the supply constraints in the residential market are much more severe than any of the other core real estate sectors. And what that's meant is that we have, even through a period of rapidly rising interest rates, seen residential prices grow. What I would say is that the commercial market does benefit from those longer term trends, but the time frame it takes to play out is of course a much longer time frame than it is in the residential space. Another area of questions we often get is around the valuation approach that Charter Hall employs for our suite of funds. Well, we believe in engaging independent valuers on a frequent basis. Typically, everything is valued independently every 6 months by Tier 1 valuation firms. We also rotate the valuers so that there isn't too much familiarity with any asset by any one valuer. And these external valuers employ a number of valuation techniques, including discounted cash flow, capitalisation rate approach, as well as looking at comparable sales. So whilst this may and does impact unit prices, we do believe as an institutional manager, it's always better to have more transparent information going back to our investor base and upholding the highest level of governance. So what did we observe in Charter Hall across approximately 1,600 independent valuations at 31 December? Well, we've tried to characterise it along key drivers and broken it down into the core real estate sectors with traffic light system. As you can see, market rental growth was green. Across all the sectors, as David mentioned, we generally saw positive rental growth. On the negative side of things, you saw higher capitalisation rates, which fed through to lower valuation levels. And probably I'll draw your attention to the bottom line. 2023 calendar year was one of the lowest transaction volumes we've seen in the last 15 years. In fact, when you compare it to even the 10-year rolling average, it was lower for all the core real estate sectors. We do expect that as there's greater certainty with peak interest rates, that transaction volumes to improve and increase as we move through calendar year 2024. So what exactly did we observe around transaction volumes and what happened in the market across the core real estate sectors? Well, let's start with office. It's had the lowest transaction volume in 15 years. You can see up there on the screen the blue chart on the left-hand side showing the volume of transactions over a long period of time and the current last 12 months circled. On the right-hand side, you can see different sectors. So not just the office market, which had lower transaction volume around 2/3, but even the industrial and logistics sector, which is performing strongly on the tenant side, and the retail markets, transaction volumes were down around 1/3. This is something, as I previously talked about, that we do think will transition throughout 2024 as volumes in the markets pick up. And as we just heard from David, gearing obviously magnifies upward movements and downward movements caused from valuations. So how are the funds, both open and closed, positioned in terms of their gearing levels at 31 December, and how does it compare to the PDS levels? You can see up there on the charts, the current gearing ranges are around 27 to 40%, depending on the underlying fund. And on the right-hand side, the open funds, all of them sit within the gearing range in the PDS. But unfortunately, as interest rates have gone up, it has led to a higher interest expense, which does ultimately reduce the amount of cash flow that's available to pay through to investors. The next slide I'm going to talk to covers off how the interest expense is built up for each of the funds. We have had a number of questions throughout the last quarter on how Charter Hall approaches management of the debt facilities and the length of debt. So this slide shows you the various components that flow through to the interest expense. The first is the base rate. So the RBA rate at the time of shooting is currently 4.35%. You will then have the lender, or typically for our funds, the big four banks, they need to receive a margin on top of that, which is effectively their profit margin. Then as a manager, we typically hedge. Hedge means you convert some floating interest expense into fixed known interest expense. And for our funds, we'll typically hedge a minimum of 50% up to around 90%, and it does depend by the fund. And you may have seen in our December quarterly update, we talked about we'd extended the length of the debt maturity. For us, this is a risk management approach. By locking in the banks for longer periods of time means that we have certainty of the debt and we can go back and renegotiate at a time that suits us. Locking in these longer term debts, I do want to stress, does not mean we cannot benefit from movements in the base level interest rates. So, if like many of the big four banks are predicting, which is interest rates will come off in Q3, Q4 this year, the funds should benefit from lower interest expense as those base rates come off. This next slide does show the investment performance over 12 months. As I've just been talking to, and as David said, when you have gearing in any investment, it does amplify the returns on the positive, and in this case on the negative. You can see that the 12-month returns across even strong asset classes such as industrial and logistics were negatively impacted by movements and increases in the capitalisation rates. And so when we're talking about investment performance, as you've heard me say and you heard David reiterate earlier, you need to look at the medium to long-term performance. Up there on the screen, you can see the 5-year returns in blue, the returns since the fund was first launched since inception in grey, and the comparative benchmark returns in red. For all the funds that have a track record of 3 years or more, the since inception return is either in line or exceeds the benchmark return. And Charter Hall is actually the largest single investor in our two largest office funds, DOF and PFA, as well as being one of the largest investors in DIF4. And when we're deploying capital and making our investment decisions, we are looking at the long-term performance like you can see up here on the screen. So now, before I pass over to our fund manager, Julian Menegazzo, I'll wrap it all up on a number of things that David and myself have already spoken to. There are positive fundamentals which we do think will continue to support the key property sectors. They will play out over the medium term, and we do think the interest rate cycle, along with most market commentators, has reached a peak with rates expected to come off in calendar year 2024. This will lead to greater confidence in the market and increased transaction volumes through 2024. Charter Hall continues to focus on attracting and maintaining high quality tenants to our buildings because we do believe maintaining long leases to strong tenants and market leading occupancy rates is the best way to protect the property income for each of our funds. So with that, I'll now pass over to Julian Menegazzo, who'll go into some more detail on each of our funds.
Thank you, Stephen. This now brings me to the update across the direct suite of funds, starting with the industrial and logistics sector. Despite a challenging 12-month period from a total return perspective, the underlying fundamentals of the direct funds remains positive. The first fund I will cover today is the Charter Hall Direct Industrial Fund number 4. DIF4 has a portfolio value of $3.3 billion in size across a portfolio of 57 directly held assets. You can see here on the right-hand side on screen the diversification with over 65% of the assets weighted to Eastern Seaboard's markets and providing access to a quality portfolio of industrial assets across the country. The portfolio also has 100% occupancy, provides a 9.9 weighted average lease expiry profile and over 20% linked annual rent reviews to CPI. DIF4 has continued to progress its sustainability initiatives with a significant solar rollout across the fund. Despite the significant slowdown in transaction volumes across the industrial sector across calendar year 2023, at Charter Hall we are always reviewing and actively curating the portfolio. Across DIF4, we successfully divested over $160 million in assets, and these assets were identified as either non-core or subscale within the fund, with the majority of sales being achieved at or above valuation. The next fund is the Charter Hall Direct Long WALE Fund, or LWF. This is a fund that is open for investment that invests across a diversified portfolio across a number of property sectors, as you can see on the right-hand side on screen, including industrial and logistics, social infrastructure, office, long WALE retail. LWF provides investors access to a diversified portfolio of $349 million, with 38% of the fund's income generated by federal and state government. The fund also benefits from a 6.9-year WALE, 99% occupancy rate, and has got long leases with structured rental increases. LWF pays distributions on a monthly basis. Moving across to the office sector now. there has been a continued focus on asset management initiatives, with the Charter Hall team focusing on maintaining high occupancy and driving positive leasing outcomes across our funds. Across DOF and PFA, there was over 47,000 square metres of leasing completed in the 12 months to December 23, which equates to around 6% of gross lettable area across the funds. You can see up on screen how the occupancy rates across both DOF and PFA compare at 99% respectively, well in excess of the PCA average of 85%, with a continued focus on extending lease tenure and mitigating income risk. Taking a deeper dive into one of the successful leasing outcomes across the direct office fund, up on screen here is a case study of the leasing strategy executed by the Charter Hall management team at 9 Castle Race Street in Sydney. The office asset is 50% owned by DOF and was sitting at an 85% occupancy rate 2 years ago. Over this time, management successfully implemented a leasing strategy, repurposed the ground floor and also introduced a new market-leading food and beverage offer, which upon delivery will provide our tenant customers with a significantly improved offer across the ground floor plane. Over the 2-year period to December 23, over 10,000 square metres of leasing has been executed at the asset and is now 100% occupied with an improved lease expiry profile of 3.4 years. Moving across now to the Direct Office Fund, or DOF. DOF is a $2.7 billion office fund, and its investment strategy focuses on core CBD and established Australian office markets. 34% of the fund's income is underpinned by the Australian government, and 58% of the fund's overall income is secured by the top 5 tenants you can see up on screen, including the Western Sydney University, Coles, Suncorp and Westpac. The fund benefits from a very high occupancy rate of 99% and a weighted average lease expiry profile of 5.9 years. Despite the challenging 12-month performance, DOF has provided investors with a 10.1% total return since inception and benefits from a 5-star environmental rating. Our other sector-specific office fund is the Direct PFA fund, which also benefits from a very high occupancy rate of 99% and has a portfolio of over $2 billion of office assets spread across the Australian office sector with a lease expiry profile of 5.5 years. The PFA fund has a focus on properties leased to state and federal governments, and this accounts for over 60% of the net income of the fund. On sustainability initiatives, the fund also benefits from a 5-star GRESB environmental rating. Management continue to work through the capital management strategy, and over the quarter, the fund unconditionally exchanged for the sale of 2 assets. Upon settlement, the board will determine the use of the sale proceeds, and in the event a further liquidity payment will be made, we will contact those investors who elected to redeem. This fund I will now cover is the Wholesale Property Series number 2, or better known as WPS2, that is open for investment to wholesale investors as defined by the Corporations Act. WPS2 provides access to some of the highest quality assets across the market through Charter Hall wholesale funds and partnerships. The fund provides a long weighted average lease expiry profile of 11.7 years, high occupancy rate of 99%, and 35% of income linked to CPI rent reviews across the underlying portfolio. The next fund is our Maxim Property Securities Fund. This fund has a different investment strategy to our other direct funds, as it invests in stocks traded on the Australian Stock Exchange. In line with recent Australian equity market performance, the fund's 12-month performance ending in December 23, Maxim delivered a total return of 9.1%, and over the long term has delivered investors 9.8%. The fund provides 98% occupancy and a 6-year lease expiry profile across the underlying portfolio, with the outlook for the sector more positive now that inflation is stabilising and consistent market commentary that the interest rate cycle is approaching or at its peak. As I mentioned earlier, this product is a little different, so I encourage you to reach out to your financial advisor for further information on this product. Finally, I will now cover the fixed life funds, being BW Trust, DIF3 and WPS1. BW's review event is in Q1 2024, and we will be contacting all investors within the fund this quarter in relation to the upcoming review event and the proposed strategy moving forward. DIF3's liquidity event is later this year in Q3 2024, and we will write to investors closer to that time on the proposed strategy of that fund moving forward. And finally, In relation to WPS1, we continue to manage that fund through its 3-year investment period. This now brings me to the end of the fund updates. I would like to thank investors for their continued support through a very challenging 12-month period. We are custodians of other people's capital, and this is something that we take extremely seriously here at Charter Hall. We remain extremely focused on executing the investment strategies across each of our direct funds and seek to provide investors with above benchmark returns through the economic cycles. I will now hand back to Stephen to close out the Charter Hall Direct Insight Series presentation.
And thank you for joining us today. That concludes our update for the December 2023 quarter. If you have any questions around what you've seen or heard today, please do contact one of the team whose details are up on the screen. Thank you.